right, so we are going to examine the traditional whole life insurance product in this video. So when we take a look at a traditional life insurance product, if you watch the overview video, that would be referred to as often a Legacy 100, L121, and there are other names that exist as well, but those are some common examples. So if I am looking at a basic old school traditional whole life insurance policy and I'm designing it for maximum cash value, what I want to understand really is how the base premium dollars function, because that is going to have a key impact on my cash value with any life insurance product. But we're going to focus on the traditional product here. So let's assume that I pay $1,000 per year into the base premium and $1,000 per year into the PUA component. Those are the two areas where I can direct my money. Dollars that I pay into the base premium component. What will happen specifically here with a traditional policy, if I'm paying $1,000 per year, and I can add a 0 or 2 depending on my situation, what will happen with your cash value in the first and second year is you'll often see 0 show up. You may have a small percentage of your base premium show up in cash value. The example you're going to see here in a couple minutes will display just that, a little bit of money show up as a result of the dividend that's paid. However, for the most part, and if you look at the guaranteed values on any illustration, with a traditional product, the first and second year, we won't have anything in cash value. The reason why is because the insurance company is going to overcharge me for the death benefit, the whole life death benefit right off the bat. Now we do add term riders when we design policies, or we can, I should say, to boost that death benefit, which mainly boosts the MEC limit, which we can send more info on that if you'd like. But why we see 0 based off of our base premium dollars in the first and second year is because the company overcharges me for the death benefit. Beginning the third year, if I pay $1,000 per year in, I'll see just about $1,000 come back. When I begin to earn dividends and interest, it picks up the pace. Versus PUA dollars, this is going to be consistent here in every video. Year 1 through all years, I see that $1,000 show up in my cash value, just about all of it. That's money I can access. Begins to yield the guarantees right away. Dividends accelerates the cash value growth of a life insurance policy, and it does buy you some death benefit as well. So when we design a policy, understanding the relationship of your money, when you pay $1 into a life insurance policy, $1, $10, $1 million, whatever it might be, understanding the relationship and how your money actually works is critical. Let's take a look here. So we're going to look at a policy that is basic, old school whole life insurance, $50,000 going in 100% to base premium, and then one where we maximized it. We squeezed the premium down as low as the insurance company would allow, as low as the IRS would allow based off the MEC laws, and just juiced it with cash value. What I'll add here is this example. It's on a 35-year-old male, same company, same product, same health rating, all that good stuff. Let's take a look. On the left, we have our 100% base premium example. $50,000 per year going into the policy. All right. Look at year 1 and 2. I pay in 50, I get $5,800. This is based off of the present dividend scale as well. If dividends are not paid, you would see 0 in the first year and the second year. Remember how they overcharge for the base premium up front? They're doing just that. Because of dividends credited in the first 2 years, I do see something show up, although it's minimal. If I look at it honestly, by year 2, I've paid in a total of $100,000. I've got a little over $12,000. Break-even point, and this is very common for a traditional whole life insurance policy. If you've ever been exposed to whole life, we hear this quite a bit when someone was sold on a whole life insurance policy or presented and they elected not to move forward. A lot of times it's because they're looking at it and they say, like, it takes 13 years just to break even. Yes, I have a death benefit, but it takes a long time to build up any real value. By year 13, I've paid in $650,000, and I have $650,000. Then where it gets very interesting Exact same company, product, health rating, everything's identical except the fact that we blended the policy for maximum cash value. So the base premium here, for transparency, is $5,000. And by the way, on our agent training program, we actually go through the detailed illustrations, show you how to design these products as well. If you're in the business and would like to see that information, feel free to reach out to our office for info on that. And we walk through how to design it and then also how to explain the detailed illustrations and all the number pages, because that piece is fun. To get back on track here though, base premium is $5,000, total out of pocket. So if I'm a 35-year-old male, same insurance company, I'm paying $50,000 in both examples here. The difference, here I've got just about $44,000 right off the bat. Now the CV, that stands for cash value, difference is noticeable immediately, about 38 grand. That's $38,000 of my payment that I now have access to. Break-even point, or when I'm positive, year 5, getting my money back much earlier. If I look by year 13, this is just time value of money, how I've gotten so much further ahead. And if we take a 0 off, add a 0, you're going to see very, very similar results from a ratio standpoint. Now we funded both of these options for 30 years. Keep in mind, this is a traditional life insurance policy. It is payable up until age 100, yet he stopped funding at age 65. So with a traditional life insurance policy where premiums are contractually due up until age 100 or 121, depending on the product we select, in reality, we can stop the payments earlier through a premium offset or a reduced paid up. Good options to be aware of there, and we did that just here. So at age 65, shut the funding down. Big difference, short-term and long-term. And this just demonstrates, in my mind, the importance of policy design. Company selection is important as well, yes, but policy design, because you've got the same insurance company here, just designed differently, and look at the difference. From start to finish, it is drastic. And it just continues to pull ahead because you've got more money in there compounding. Death benefits much longer as well. Right? If we're thinking long-term, I can leave a larger legacy through this guy. So that has more to do with our policy design, but overall, we've got our traditional whole life insurance product here. The main thing I wanted to be aware of, or that I wanted to highlight here, was the early years. My base premium does not show up in cash value, or a very, very small percentage. Same thing over here. You've got the 5K base. Cash value in the first and second year. By year 2, you've got about $90,000 in cash value. That $5,000 base premium didn't show up in cash value in the first and second year. You've got a little bit of a dividend like you did in this example, but really what's driving the upfront cash values in this example is the PUA component. So, hope that this one was helpful. The traditional product is something we use quite a bit. I do like it very much so. Aside from the early years, you can somewhat compensate for the early year lag in performance with a properly designed policy. The advantage to a traditional whole life insurance policy, in my opinion, is that you have the ability to pay into the policy as long as you'd like, but you're not required to. Like you saw in that example, he stopped funding at age 65. In reality, he could stop funding after 4 or 5 years if he heavily funded it, like the example you saw in the max blended policy. Overall, great product to be aware of, something that is very, very common. Most individuals have been exposed to traditional whole life insurance products that have seen whole life insurance, but I definitely am a fan of that product. I hope this one was helpful. Reach out with any questions. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.